Boom, boom, boom. Yeah.
Boom, boom, boom. Happy Thursday. Welcome to Bear Market Brews, brought to you by Hixon, Zuercher, Capital Management. I am Tony Hixon. It's 4 o'clock. The markets are closed. And so is the barbershop. The markets are closed, but our virtual happy hour is about to begin. As always, I am joined today by my venerable and esteemed colleagues, Adam Zuercher and Austin Wilson. We invite you to sit back, relax, crack open a bottle of your favorite brew or beverage or water or tea as we break down all things COVID-19, show you how the markets are responding, and share our latest views. At the end of every call, we love your questions. There will be Q&A at the end, so get ready. Here we go. The brewery is hopping, and we are happy, and we want to make sure our attorneys are happy too. So before we get to introductions, let's take a quick glance at our disclosures. All right. Enough of that. That's crazy stuff. What's going on, guys? Adam, Austin, how you guys doing today?
Doing great.
Going good. The market closed in the green.
Woo!
Red most of the day.
Aren't there like 20 million people that are unemployed right now? How's it up? I don't even get it.
Something like the last 3 weeks, we've had record numbers of jobless claims, and the market closes green every time.
Yep.
Hard to believe, isn't it?
Unprecedented times we're living in. So we want to thank all of our attendees and guests on today's virtual happy hour. For those of you who are joining us for the first time, we want to go around the room. Adam, we'll start with you. Who are you? And most importantly, everyone wants to know, what are you drinking?
Well, my name is Adam Zuercher. I am CEO and Chief Investment Officer, as well as one of the co-founders of Hixon, Zuercher Capital Management. And we've been at it now this will be our 18th anniversary in August for our firm. So believe it or not, we started our business in a bear market almost 18 years ago. So it's been a great ride. This is our third bear market, official bear market, where we've had a 20% downturn in the market. And we are here to help you navigate the current environment. There's a lot to digest. Things are moving quickly. So we hope to provide you with some awesome information today. But make sure, go ahead and put your questions in the chat. We want to hear from you. While you're doing that, I am drinking a dry hopped blonde from my favorite brewery, the Finley Brewing Company. Supporting the local brewers, keeping them in business.
Oh, that's awesome. I love it. Yeah, it's a great place to go. All right, Austin, how about you? Who are you and what are you drinking?
Yeah, well, I'm Austin Wilson. I have been a research analyst at Hixon Zuercher Capital Management since beginning of 2018, and it's been a bumpy ride since then. Lots of corrections, but one bear market for me. And learning new things every day and just making sure that everyone on our team is informed with what is going on in the markets and going on with the virus specifically. And it's been a wild ride, but I'm surely enjoying it. So it's been good. And as far as what I'm drinking, I have to show the can. I drink local too. This is the Peaches Cream Ale from Finley Brewing Company.
There you
Peaches.
go.
And it's very good. So peach is my favorite fruit. And it's pretty good. It seems a little bit cold outside to be drinking something with peaches in it, but it's pretty good. So, Finley Brewing Company is a winner here as well.
FBC. All right. I am Tony Hixon, partner, client-facing advisor. I threw my bottle away. I don't have the exact name. It's a Hefeweizen. I shop local. I got it from the wine merchant down the street. It's an awesome place to go. Good stuff. I cannot wait for today's call. But what's most important right now, attendees, what are you drinking? The chat box in the webinar is down below. Click it and share with all panelists and attendees. Click the drop down. all panelists and attendees, and type in the chat box, what are you drinking? And where are you calling in from? We love our guests. Where are you from? A lot of them from Ohio. Is there anybody outside of the state of Ohio? What is it that you are drinking today? While you're typing some of those comments into the chat field, I would remind you that there is another button, the question and answer box. The question and answer box goes straight to the panelists. And if we have time at the end of the call, we will answer those questions for you. Jeff is drinking some Kentucky Bourbon Barrel Hard Peach Tea. I love it. Warren, some Ryan Geist. That's local. That's, Cincinnati, I believe.
Cincinnati.
Can't do that stuff. We will continue to read your comments throughout the rest of our time together. And we appreciate you attending the call. So, from the three of us to the attendees, a virtual cheers. The happy hour about to begin. Cheers. Here, here.
Cheers.
Cheers.
All right, all right. Austin, I am going to turn the floor over to you. You have some thoughts on current stats on the COVID-19 crisis. What you got?
Absolutely. So we start here in the United States, where most of us are probably sitting. We now have, no surprise, still the number one number of cases in the world, but over 640,000 confirmed cases of COVID-19 here in the States. But on the next slide, we see that we are seeing a decreasing rate of new cases. So what we see in the blue, U.S. cases change day over day. What we see in the orange is the 5-day moving average. And we see that on the 41st day, really, since we've had 100 cases, so we've been tracking this every single day, we were under 5% day over day change. And right in the last couple of days, even been hovering right around then. But that was a very, very good sign for us. And we really liked to see an under 5% day over day growth day. So cases growth is slowing overall, and that orange line is going down and to the right. So typically what we like to see is up and to the right, right? Well, in this case, we want to see down and to the right. So
exactly.
Let's hope that this trend continues. Another trend that is similar is on the next slide. We see deaths in the same way. So we're seeing COVID-19 related deaths, and those have also, the gray line, 5-day moving average, been ticking downward over time. There is a little bit of noise within the last few days because specifically New York issued some additional deaths were added to their count because they did not have a known cause, and that inflated their latest figures. But overall, down and to the right is continuing what we see in that trend as well.
Austin, are you saying that there are deaths that are included in the total death count which haven't been officially diagnosed as COVID deaths?
Yeah, unfortunately there are, and I think that this is happening all around the country. We just recently heard about it in New York, but there's a couple of facets to this. And number one is that it is if you don't know, if something happened very quickly and you don't know exactly what caused it, that could be an easy thing to pin it on. Number two is that all kinds of things are happening regarding case numbers and hospitals needing things. So as their case numbers change, their needs change, and they could get more or less assistance as those case numbers grow. So I think that there could be a little bit of noise in some of these days, and they could still swing. But as long as that overall trend continues down and to the right, I think we're headed in the right direction.
Another point I would make is I saw a chart just earlier this week that showed influenza death rates, COVID death rates, as well as pneumonia death rates. Pneumonia dropped straight down vertically off the charts, meaning I think a lot of pneumonia deaths may be categorized as COVID deaths. So
I think that's entirely possible. And that's an issue that I think we're going to run into throughout this pandemic is not every single person who has some of those symptoms is still being completely tested at this point. So they could be inaccurately marked as being COVID. So these numbers, every number you see, a lot of numbers are very accurate, but some numbers have to be taken with a grain of salt when you're looking at millions of people.
So and one of our attendees said that he even saw a skydiver without a parachute died of COVID.
Hey, that is entirely possible. So take a step back from the U.S. and look at this from a global perspective, as we like to do. We now see over 2 million, specifically over 2.1 million people now have officially contracted COVID-19. And that is a number that is growing, and we're hoping that it slows the growth. That's the goal here. So if we look at what we call the curve, everyone talks about the curve. So let's look at the next slide here. The curve is flattening, specifically in the U.S., but really in all of these developed countries except for Japan, which Japan just issued a state of emergency yesterday, a nationwide state of emergency, because they've had a very, very linear looking trend of growth of infections there, where the rest of the world has really the curve has flattened a lot more. So in the U.S., I think the social distancing is proving to do its job, and those cases are increasing at a decreasing rate. So yes, we're seeing new cases every day, but we're seeing new cases every day that are less than the day before, or generally in that direction. And that's a very, very good thing. So continue to stay home and do what we do, and don't touch your face, and I think we'll be okay. So social distancing seems to be working here. We see on the map, when we take a further step back and look at the hot spots of the world, the U.S. has the #1 case count in the world, as we know. But we really have a hot spot in Europe going on right now. And so Spain is actually #2, followed by Italy, followed by France, followed by Germany in terms of case counts. And all of those countries, very, very close together. So they are definitely growing exponentially, as well as everything else. But I think that's a hot spot of the world of growth. And that's something that we're continuing to watch. So really, if we think about this a few weeks ago, China was the #1 place in the world where COVID-19 cases occurred, But since then, now 5 countries have surpassed the case count that China has. Now, throw into the wind the fact that a lot of people are questioning the official numbers from China. But in general, we're seeing a lot of growth elsewhere.
Indeed. So here in the U.S., to deal with the pandemic, we've got some monetary and fiscal stimulus. Let's take a look at what did the Federal Reserve do to help navigate this crisis for the American citizens.
I just want to take a moment and say that I really like charts. Okay. I like building charts. I like looking at charts, and I built this chart today, and I was pretty proud of it. So
great job.
The chart that we're seeing here is the actions the Federal Reserve has taken to offset really the impact of the COVID-19 pandemic. So those come in 2 different areas. They're all under the umbrella of monetary policy. So this is opposed to fiscal policy. This is monetary policy. Monetary policy, they did 2 things. In the white line, we see interest rates, and the white line corresponds with the right axis. So on the right, we see that federal funds rate, which is really the overnight lending rate to banks. And so banks lend to businesses, and the further out you get, the interest rates go up. But this is like the base interest rate, and base interest rates are at 0-ish now. 0 to 0.25 is the overnight lending rate to banks overnight. Lowest they've ever been, and they were there a long time after the global financial crisis, and they're there again. So that was the first thing they did, and they did that through a series of emergency rate cuts. Mm-hmm. So that's where we're at as action #1. Action #2 in the orange. Go back to that. Yeah. Action #2 in the orange we see here is that the Federal Reserve has once again instilled the policy of quantitative easing. So quantitative easing is really the Federal Reserve going into the open market and using money to buy fixed income securities. And they have done this in a number of different areas of fixed income securities, but you can see that the Federal Reserve's balance sheet grows as a percent of GDP when they're using this quantitative easing policy. And that happened coming out of 08-09 and really peaked in 2014. And now what we're seeing is the trend exponentially just grow very, very sharp upward. That's where that red arrow is pointing up, because they have an open-ended policy for quantitative easing. So they really can do whatever they want and buy whatever they want to instill liquidity and, stability in the fixed income markets. And that orange line corresponds to the left axis there. So a cool graph there to see what the Federal Reserve is doing in really quick and unprecedented measures so far.
Indeed. And would you say that those measures have helped?
I think that they've definitely stabilized the fixed income markets. Fixed income markets were, extremely volatile, and areas of that were sold off far more than you would have expected early into this crisis. But those actions that the Federal Reserve has taken really have proved to stabilize those markets and instill some liquidity there, so people can go and buy and sell as needed.
Cool deal. So that was what the Fed did. That's a monetary
Correct
stimulus. What was the fiscal stimulus?
Yeah, the other side of the same coin, government intervention to fix, to do what they can to get the economy to get by, is fiscal policy. So fiscal meaning spending, government spending. So the government passed what's called the CARES Act, which we talked about a couple weeks ago, but overall, $2 trillion with a T. $1 trillion is a lot of money. $2 trillion is 2 times a lot of money.
Yeah.
And they went and spent that. So obviously this week, a lot of Americans saw payments into their checking account if they filed their taxes electronically for this stimulus. And that's $300 billion of this package. That's a good chunk of it. And that should help them to A, pay their bills, but B, maybe go spend some money in the economy to kind of help things along during this time. The main portion of this that I want to talk about is small business loans. So $350 billion of this $2 trillion were allocated to small businesses to really keep their employees being paid during this time, as well as paying other necessity bills like rent and things like that. So it's not funny. The reality of what came out today is that this $350 billion is gone. It's already spoken for. Yeah, it is. It's spoken for. The $350 billion has been claimed by small businesses. And as of right now, there is no clear direction. There's no clear direction that we have an answer to put something into effect really quickly to get more money to small businesses.
Yeah.
So they've talked about it, but they've said there's no official legislation to get more money.
Exactly. Nothing official yet. That is something where everyone is holding out for, and especially small business owners around the country. If you weren't among the first, I don't know how many businesses that were, but that took up that $350 billion, you're waiting on the sidelines and have bills backing up.
Yeah.
I will say it is quite impressive, the speed at which the government passed the legislation. So the CARES Act was passed at the end of March. And small businesses, they could apply for the Paycheck Protection Program, which is the $350 billion you're talking about. And I believe that was 2 weeks ago tomorrow that they could first start applying. The problem was it all rolled out so quickly that the banks weren't quite ready to handle all the loans and applications. And it took some time to iron things out. And so I'm hearing that most businesses are receiving some at the end of last week, and most are coming this week. They're actually receiving the money from this program. But if you really step back and think about it, that's unprecedented speed, especially from the government, right?
Right.
Mm-hmm.
Yeah.
Yeah. It's been fast and big, which is a good thing. And I think we learned coming out of 08 and 09. Yeah. Fast and furious. Exactly.
So today we got the news that small business loan was pretty much extinguished. We also got jobless claims. So let's take a look at what that number came out at this morning.
So this morning's jobless claims came in at 5.245 million new jobless claims. So really looking back a week. So 5.245 sounds better when you're comparing it to 6.6 million. And I think that is something that the equity markets are seeing as a decent sign. Things are not great, obviously, right now, and a lot of people are still without work. But the fact that the jobless claims are growing at, again, a decreasing rate is a very good thing for the economy. And again, as more businesses get the money in their accounts and can afford to pay their employees, maybe they'll bring some of them back. Maybe we'll get another phase of the Paycheck Protection Program, and that will allow people to come off of unemployment as well. Yeah. So another big number, and I think the numbers like over the last 3 weeks, 22 million or so unemployed due to this virus, and that's clearly a lot of people.
Clearly a lot, and obviously having some impact on consumer confidence. Give us an update on where that metric's coming in at.
Yeah, so as of last week, so this number has not changed since last week, comes out once a month, but consumer confidence had sharply dropped from really over 100 early in the year down to 71, which is firmly into the area where we would say a recession is pretty imminent. And when consumers are not confident, consumers don't spend money. And when consumers don't spend money, well, the economy does pour and the stock market follows suit.
Mm.
So that's kind of where we're at right now. The drop in consumer confidence can be related to the increase in unemployment, and that is driving corporate earnings. People are estimating that's going to impact corporate earnings and the economic growth, which is impacting the stock market.
So you got 22 million people unemployed, and a lot of those who are still employed are probably working from home, which means the car is in the garage.
True.
What impact is that having on gas and oil prices?
Well, oil demand has pretty much been free falling this entire year. Now, we see a very sharp down into the right trend here. Oil actually closed under $20 a barrel today. That's really, really stinking cheap.
That's low.
But when people aren't driving and companies aren't making plastic products use petroleum. They're not paving roads. Those products use petroleum. That is when you run into demand issues. And when demand's not there, prices go down. Well, that's what's caused oil to go here. And what we had last weekend was a meet with the oil producing economy countries really of the world, plus a couple extras like Russia. And they met and decided, hey, oil prices are bad, and that's not good for our economies, which are heavily tied to our oil drilling. So let's cut production by almost 10 million barrels, which was really huge. And it further instilled a little bit of a floor kind of around the $20 per barrel mark, not exactly, as we did close under 20 today. But I think we're going to get a little bit of stability in the oil markets from that. What that has done is caused any company with oil, drilling, refining, retail exposure, those stocks have just been beaten up this year. We think
we
that
sit catty corner to Marathon's global headquarters, so
exactly.
we're well aware of the hit that they've taken. So, Adam, I want to turn it over to you. Let's get a quick check-in on where's the markets at year-to-date in 2020. A lot of volatility. Let's chat about the S&P, the Dow, and the NASDAQ. What do we got?
Sure. So, yeah, to your point, we've had exceptional volatility this year. In fact, as we'll get to in the next chart, the highest volatility on record about a month ago. What you're looking at now is year-to-date returns. In white, you see the S&P 500, in green, the Dow, and in blue, the NASDAQ. And I prepared this chart earlier today, right before the market closed. So what you see is actually the Dow and the S&P are about in the same position they were when we had this event 1 week ago, so last Thursday. S&P being down about 14% year to date. That's coming off of, well, if you look from the drawdown off of the February 19th high, so, we peaked back here in February 19th, and you look at the low back on March 23rd, that was a 35% drawdown. Now we've rebounded from that, and we're down 14% year to date. Dow is down about 18% year to date. We use the S&P a lot. We like that. It's a more diversified, more accurate reflection of the overall market. You have 500 stocks instead of just 30 stocks in the Dow. And then you also have the NASDAQ in blue. The NASDAQ is really showing some strength in this environment. And the NASDAQ is made up heavily of technology stocks, and the NASDAQ's down just 5% year to date. So as we mentioned in previous events for Bear Market Brews, I think 2 weeks ago, we reviewed different sectors, and we showed that the tech sector has been the strongest sector. And actually that's what led the strength at the end of the day today. So that continues. That trend is not going away. And if you think about it, it's technology that has enabled us to actually get by during this great shutdown that we've had with the coronavirus. Mm-hmm. And so I am glad that this event is happening now and not 10 years ago or 20 years ago, because we have such great technology from great American companies.
Indeed. So a lot of volatility along the way. Let's check in on the VIX, the volatility index. What are we seeing there, Adam?
Yeah, so the VIX is just a measure of volatility for the S&P 500. And so it's basically telling us, first off, as I mentioned, we saw unprecedented numbers. We saw a VIX rating of 82 back on March 16th, exactly 1 month ago today. That was the highest level the VIX ever had, even surpassing, not by much, but even surpassing the 2008 volatility.
Yeah.
Now we are at half of those levels. The VIX rating today is at 41. So we've seen volatility come down substantially in the last couple of weeks. That is very important. And let me show you why on the next chart. What we really want to see long term, the VIX, around 20 is kind of normal. And what we really want to see to be bullish on the market is a declining VIX. And so, coming off of that 82 level, we're now at 41. Also important is the 20-day moving average. So that's just taking a look at the last 20 days and where the trend has been going. And what you see here is a nice declining trend on the VIX. That's exactly what we want to see to start getting bullish on the market. Another thing I would point out is a key level that we were looking at was this 60 level. We wanted to see the 20-day moving average stay below 60 or turn below it if it did surpass it. So we are certainly seeing a setup for being bullish in the future. And this is exactly what we were looking for when we, got, a little bit defensive and bearish a month ago. This is a signal that we wanted to see to get more bullish.
So volatility seems to be decreasing. We also like to see breadth. What is breadth, and what are we seeing in this environment right now?
So breadth is just simply a measure of what percentage of all stocks are participating in the gains. So if you see the stock market rising, that's great. But what you really want to see is you want to see a large percentage of stocks in the market also rising. You don't want to be dominated by just one or two stocks. So the S&P 500 is a market cap weighted index. So for instance, Apple is one of the largest companies in the S&P 500. Apple's performance drives the market more than many other companies does. And what you want to see is you want to see a large number of companies. So what we've been looking for is there's many ways to measure breadth, but one of our favorites is the percentage of stocks that are trading above their 200-day moving average. And that's what you see down here in the bottom left. And what you see is right now, 19% of all S&P 500 stocks are trading above the 20-day moving average. So, right around 100 stocks are trading at above their 200-day. And the reason the 200-day is important is because that's generally the long-term indicator, the 200-day moving average. If a company is trading above that, that means it's in a long-term uptrend. So what we've been telling you in past bear market brews is that one thing we've been looking for is this number to break out above 15%. Because historically, if you look at this bottom chart, this red line here, that's the 15% line. If you dip below that, when you then go back above it, that's usually a good entry point. In last week, so 2 weeks ago, we had just 9% of the S&P 500 trading above its 200-day moving average. Last week, that went to 16.8, and today it's at 19.4. So certainly we see a trend developing here. We see more and more stocks rising above their long-term moving average. That is a bullish indicator. And we have now, exceeded that 15% level. So it's another sign to us that it's time to get more active and go on offense here. We think the market is poised for an uptrend here at some point.
Good deal. So we got volatility decreasing, market participation, breadth is rising.
Yeah.
What about some moving averages? How are some charts looking for moving averages?
Okay, so a moving average is simply an indicator to kind of smooth out the daily price action of the market. What you see on this chart is you see in the white, that's the daily price change of the market. And obviously we peaked right up here about February 19th, and we've had this downtrend. And each white bar represents every day's move. What you want to see though is we can smooth out those, by looking at an 8-day in the pink, a 21-day moving average in the yellow, a 50-day in the blue, and a 200 in the green. Those indicate basically price patterns. And so what we see here is that the 8-day in pink, if you go back to last Thursday was the first day where the 8-day crossed above the 21-day. That was a bullish sign. We want to see a bullish crossover where the short-term moving average crosses above a longer-term moving average. So that was the first signal we got. Since then, and by the way, back around that same time, we were trading at the same level that we are today, right around 27.90. And one of the most bullish things that has happened in the past week is on Tuesday. I don't know if you can see this bar here. I'm circling it. But we traded above the 50-day moving average for the first time. The 50-day moving average is the intermediate trend of the market. And the fact that we closed above it was a bullish sign. So the last couple of days since we've closed, we've been trading below it. That is a key, very key price point. We are at a critical point in the market. So we initially talked about the fact that we could have a kind of a W-shaped. You see what's happened here. We hit a low, we've rebounded. The question is, do we go back down and retest those lows and then go up and we have this W pattern, or do we continue to rise and just have the V pattern? Well, nobody knows for sure, right? So even if we have the W, we're comfortable with the fact that we might retest those lows, but we don't think we're going to break those lows by much. We have turned bullish because the market is telling us, based on the Fed action, the government action, the market likes what they're seeing. And the price action is telling us it's time to get bullish.
So the great government backstop is working. So we've had this epic drawdown. We've had about a 50% retracement. What is some data that we're seeing revolving around that 50% retracement?
Yeah, so if you look at this chart, this is a 6-month chart of the S&P 500. And right here is where we peaked on February 19th. And price level of 33.93. The low we saw on March 23rd was at 21.91, okay? So where we're trading at right now is right around this magic level of 27.92. Actually, today we closed at 27.99, which is actually very positive because this price point represents a 50% retracement off the lows. In other words, if you look at what it takes to recover, we've gone halfway back to the all-time high. I mean, we'd all like to see that next half happen, but that's where we are. We're halfway there. The question is, again, is that going to act as resistance, and will we see another leg down, or is that number going to be sustainable? If we can hold above that 27.92 level, that is a very positive indicator for the market. And I was very pleased to see the strength at the end of the day. The market actually closed at 27.99. So that is, once again, a bullish indicator. And I know it's hard to believe, but even though you see a lot of negative in the market, or I'm sorry, a lot of negative in the news and a lot of negative things, a lot of uncertainty and questions, you have to remember that the market looks forward. The market is forward looking. It's already discounting all of the bad news. History tells us that the market will also often bottom about 200 days before a recession actually bottoms. So, we very well could be in a V-shaped recovery. Nobody knows for sure, but all of the indicators that we're showing you are showing pretty bullish patterns. And so we're pretty pleased with that.
So nobody knows, but that's why the three of us on this panel love what we do. Data drives decisions. And so every day we put 2 feet on the floor to make wise decisions on behalf of our clients and investors. And we certainly appreciate those who've entrusted us with the stewardship of their portfolios. So Austin, haven't heard from you for a while. Let's wrap this sucker up. We've seen a lot of bullish stuff, some things that maybe not so much. Let's get a summary. Where are we at? Bullish, neutral, bearish? Let's go.
That's right. We got 9 things to talk about. So number 1, COVID-19 curves are flattening. Here in the U.S. as well as around the world, new cases day over day are decreasing, and that's something we really want to continue to see. Number 2, and specifically of interest today, because at 6 o'clock, the president will be holding a press conference to detail some of these items. There's a lot of talk about reopening the economy, and we actually just got some news late in the afternoon that May 1st is kind of a signal time for a lot of states that he'll be working on with the governors on. So that's something we're bullish about. So the top 2 things, very bullish. Number 3, oil prices are rebounding. Production is being cut. That is causing prices to kind of stabilize because demand is notably down as most people are not driving. Most factories are not producing. That's causing a lot of demand to be down. So we're bullish about that, but we are neutral about jobless claims because while they were better than the forecast and better than last week, we still are, if we had 700,000 or so as the record before COVID-19 on a weekly jobless claim basis, we're still in multiples of that on a weekly basis at this point. So while it's better than it has been and better than estimates, jobless claims of 5.2 million, we're feeling kind of neutral about.
I would say the other reason we're neutral there is because of the trend in jobless claims. So we kind of peaked was it last week, Austin, or the week before?
It was the week before.
So the fact that this week came in less than last week, we've shown you on previous bear market brews that there's an inverse correlation between the number of jobless claims week to week and the actual direction of the market.
Right.
So if we start to see this number coming in less and less each week, that's a positive signal for the market, irregardless of how high the number might be.
Yep. So we will be watching that number each and every week on Thursday mornings at 8:30 when it comes out.
It's like a party.
Next, we note that small business loans have had their funding limits met from the CARES Act. That $350 billion has been spoken for. So we are a bit bearish about that until the government approves additional stimulus and aid in that area of the economy. So that's something we're watching very, very closely each and every day. But that first portion definitely has been spoken for. Number 6, volatility is calming down. The markets are calming down. It feels like we're no longer seeing the 2,000-point swings in a day on the Dow. We're seeing more reasonable, more palatable moves, and then it's leaving us feeling a little bit more bullish. The volatility index, or the VIX, is about half of what it was at its peak, which was all-time highs just a few weeks ago, and we feel good that that number has come down substantially. Number 7, a lot of companies, a lot of stocks are participating in this rebound we're having, and we feel very bullish about that. It's not driven necessarily by the big market cap names, so the Apples of the world, the Amazons of the world, the ones that take up huge market caps. That is not driving the market as much as everyone is driving the market. They're doing very well all by themselves for sure, but a lot of companies are participating, and we're bullish about that. Number 8, the stock market is changing direction. Those moving averages on a short-term basis have indicated to us that what we are seeing is a more healthy price environment where the short-term moving average has crossed the longer-term moving average in an upward direction. And moving averages tend to perform 2 ways in when the markets move. They can form as resistance, or they can form signs of support. And we're hoping that as we continue to go up, that these moving averages will be support and give us some stability and more upward momentum. So that's a good thing for us. Number 9, as Adam talked about, the direction of the market is kind of at a key resistance level right now. That 50-day moving average, that 2590 or so number that we're seeing, we would love to see it continually break out above that. Otherwise, if it does not, and it kind of has some trouble getting out of this area, it could form some resistance to further upside movement. So we're kind of at a turning point as far as the stock market has concerned. But out of 9 things, we're seeing that 6 of them are leaving us feeling pretty bullish, and 6 of 9 is pretty good.
Indeed. So we started this fun virtual happy hour a few weeks back, and we're seeing a lot of green here. Adam, what are we thinking going forward for the bear market brews?
Oh, that's a great question, Tony. So when we started it, we started with the idea of communicating to our clients everything that was going on in this current bear market. And today we have an announcement that today is the last Bear Market Brews happy hour.
Oh, that makes me sad.
Me too, because we never got Austin to sing the Bear Market.
I know.
I tell you.
It just didn't get deep enough, you know? I mean, I think things are turning up and Austin's not going to have to do it for us.
It was too short of a bear market.
It was, well,
we can't really say that.
We can't officially declare
Right,
that the
right.
bear market is over. But what we can say is that our virtual happy hour every Thursday is over for now. And let me explain why. So first and foremost, I want to thank every single one of you for joining us. It has been a great ride every week.
Cheers.
Having you join us. So thank you for being part of it. We appreciate your questions. They have been fantastic. And when we started this, the reason we started it 4 weeks ago was really to communicate to our clients what we were thinking as we go through this bear market. So for those of you on the call that are clients, first off, thank you for your trust. And we love working with each one of you. And we are excited to see you achieving your goals. And many of you asked us, well, how will we know when things are getting better? You know, what are you looking for? And so one of the purposes of Bear Market Brews was to communicate to our clients some of those things that we're watching week to week. As you may have picked up on last Thursday, we started to get bullish. We started to see some early bull signs. And this week, those bull signs were confirmed. That doesn't mean that we couldn't retest the lows. That doesn't mean that we couldn't have another pullback. But what it means is that the worst case scenario has really been, in our minds, almost eliminated. I guess you can never eliminate it completely. But the probability that we will see the worst case scenario that we had in mind back on March 16th, 1 month ago today, when we really got kind of bearish, we think that's been eliminated because of really, number one, the unprecedented speed and magnitude of the government's response. So whether you like it or not, the government has responded quickly and big. And so that has helped backstop the economy. Number two, the coronavirus seems to be dissipating a little bit. You know, I know there's a lot of long-term concerns. You know, what happens if we open the economy too soon? Could there be a second surge of cases? But we are pretty optimistic on the healthcare. You know, there's over 70 companies working on a vaccine. And so, and there's companies working on therapies. There's a lot of positive news out there. I know it's hard to kind of decipher good from bad on social media. You hear it all. But we are really, our filters are showing us more positives than negatives. And so we are bullish. You know, we think it's time to put fear aside. We think the worst case scenario has kind of been eliminated. And we are moving forward knowing that all of the signals that we were, and that's the other thing I want to point out. It's very easy, you know, as investors, the worst thing we can do is make decisions based on our gut or our emotion. And it's very easy to think of things that could go wrong right now, right? But you have to look at data and you have to look at facts. And a month ago, we identified a list of data and facts that we were going to look at. And we told ourselves, when this data comes in positive, when these indicators show bullishness, we are also going to be bullish with our clients' portfolios. And that's what we're seeing. Even though there's certain things that we don't like, there's certain, you know, we certainly don't like the fact that the economy shut down, that there's businesses that are hurting. We don't like that there are people that are dying. And if you're personally affected by this, you are a family member, we are sorry. We are sorry you are going through that. And we're not minimizing that by any means. But what we are saying is the weight of all of the evidence is showing us that it's time to take a more optimistic view. It's time to get bullish on our future. And we are excited about the future of America and the future for investors. And so for that reason, we think that if we were to continue the bear market brews, it might be a little bit redundant to you. And we've done our job of communicating the most important facts when it was most timely.
Awesome.
So from this point forward, we're gonna discontinue the bear market brews. That being said, we would love to hear from you. If you have questions, don't ever hesitate to reach out to us.
Yep. And should the bear market rear its ugly head again, we may bring it back. So we have some listener questions. We love it. Now would be the time to type your question into the Q&A box while we have a couple on tap. But before we get to those, I just want to mention that we're here to help, right? We put 2 feet on the ground every day to help investors make wise decisions with their money. And for many investors, this crisis has left you unsure with what to do next. It's our belief that most investors do well with an advisor. If you don't have an advisor, we think you should. And a good financial advisor is there to help you in times just like this. Head on over to hzcapital.com/start. Walk through our 6-step process. At the very end, if you feel like you qualify, we would love to have an introductory call. Schedule a call with us. Okay, let's get started. And we'll see if we make a great fit for you. We are passionate, we are experienced, we are credentialed, and we are ready to meet investor needs. Many of you on this call are clients, and if so, we are grateful and thankful and humbled by the opportunity to manage your investments, and we want to help other prospects just like you manage through these times as well. So head on over hzcapital.com/start, and we would love to assist. All right, last week we had a question come in the queue, and Austin, I'm gonna ask this one to you.
Uh-oh.
The question was, we talked about breadth, which is the percentage of stocks that participate in the rally. The question was, do we know the breadth of participation of investors in this rally? Like, is this all just like big banks and big institutions buying, or has the retail investor, the individual investor, piled in as well? What is the breadth of participation in this rally?
Yeah, that's actually a really, really good question. And one thing I will note is that when things were sharply selling off, so think 3 or 4 weeks ago, and we were having those huge down days, what was happening is a lot of electronic trading triggers were being triggered as the market hit certain resistance levels or certain, percentage drops from their highs. And what that means is that a lot of the institutional money was selling and going to cash, which then compounded things and made things go down quicker. So on the downside, what we were seeing was institutional money kind of going onto the sidelines for a bit. But the contrary to that is that the individual investors were the ones doing some buying. Now, in the grand scheme of things, it was smaller dollar amounts than we were seeing as far as the big guys. But retail investors were doing buying on the way down, which is a very, very good sign. And what we've seen as volatility has come down and the magnitude of those trades has come down is that it's kind of been an even split. As things have rebounded, both institutions have been doing some buying and retail investors on this upside. So that leaves us feeling a little bit better. But I will say that when we're having these big swings day over day, that is largely caused by a lot of the institutional money, which is just much, much bigger than retail.
Indeed. Good answer. So, Adam, I'm going to have this next question for you. So our relations with China over the past year and a half, 2 years haven't been great, mainly revolving around trade. This is even prior to the coronavirus. So how will this new coronavirus issue affect the stock market in the U.S. for the remainder of 2020?
Well, fantastic question. I guess nobody knows for sure, but I can make an educated guess. So, let's go back to where we were before all of this started, and we were in a trade war with China. And we had some very positive progress towards the end of last year, beginning of this year, and things started to look up. And, I think if you want to look at how will it affect the U.S. stock market, I think, for one thing, I think all of that's been put aside. I think we all know that the coronavirus is a bigger issue, even the president, and he's acknowledged that. So I don't think the trade war specifically is something we need to worry about for the rest of this year. One thing, to worry about is that I think that we have, I have a lot of questions about the data of coronavirus statistics coming out of China. Certainly, there seems to be some issues and some questions around that. And I think the other issue is that President Trump has, announced that he's going to discontinue the funding to the World Health Organization. And what that means then is that and really because he doesn't feel like they alerted us quick enough and they were honest about data from China, or that China was honest with data to them, which means that China may need to pick up the funding for that organization. So there's a lot of political things going on right now. China is certainly being targeted right now as being very deceptive about where the virus began and how we're going to deal with that. So I think there's going to be a little bit of political conflict with China. And so I would side with the US, obviously, there's a lot of strength here. I think I view the US markets as favorable to, say, the Chinese stock markets at this point.
Good. Cool. Thank you for that. All right, Austin, you're up next. We have a question from a listener. What sectors should benefit from the upcoming, quote, getting back to work scenario in May?
Yeah, I think that there are a handful of things that I would say are going to be favorably impacted. I think it's probably, I want to start with saying, I think it's probably too early to say that energy and oil is going to bounce back that quickly. So that's probably one I would say is it's not going to be unfavorably impacted, but it's not going to see the rebound that a lot of other sectors are. I think that largely technology, being that businesses are still going to continue to spend, consumers are going to continue to spend on technology. I think that is one that's going to drive this rebound, as well as consumer discretionary. I'm betting that once we get back to work, paychecks start flowing, that the consumer will continue to be strong. I don't think it will be the exact same as it was before. So I think while a consumer may hesitate to pull the trigger on a $30,000 F-150, they may be willing to pull a trigger on a cup of $4 Starbucks coffee. So a theme that we like is something called affordable luxury. So things that are cheap yet kind of give you a sense of luxury, we feel like could be an opportunity for this rebound.
Cool. Good answer. All right. Thank you to our Facebook Live listeners. We do have a question coming in from Facebook Live. Adam, I'm going to hand this one over to you. We have a listener who is asking, would it be best to withhold making payments on student loans and maybe put these funds into investments during this forbearance period? Or should one be making the payments on the loan during this period? You've been a client-facing advisor for 18 years or more. What are you thinking there?
Wow, that's a great question and very insightful. As the government has waived those payments on student loans, as an advisor, I always tend to take the more conservative approach and say that, paying off debt is always a good strategy. But at the same time, it is always good to take advantage of low interest rates or the opportunity to not have to pay on loans. It really kind of depends on your personality and your risk tolerance. I think if you have a more aggressive risk tolerance, then I think, well, yeah, that might be a possibility. There is certainly an opportunity to buy stocks here at these levels. But I think if you want to be conservative, a win-win approach, something you will never regret, is paying down debt. So I know it's not as fun and it's not as glorious, but if you pay down your debt, even while interest is deferred, that means more of your payment is going to principal. So I think ultimately that's probably what I would recommend as a prudent strategy in this environment.
Good advice. Adam putting on his Dave Ramsey hat. I love it. All right, Austin, over to you. We have a question coming in from the webinar. What do you think is the long-term outlook for inflation, given how much money has been printed by the Federal Reserve?
Wow, great question. It's easy to look at that and say, wow, the government is just stimulate the economy with trillions of dollars. The Federal Reserve is essentially they have a blank check and they're just doing whatever it takes. So it's easy to look at that and say that inflation is going to go higher. But what I will point out is that in 2009, we saw similar quantitative easing approaches and interest rates at zero for a long time. And inflation was very, very low, really, for the last decade. So what I would anticipate is that due to the nature that we are a very developed, very mature economy, our growth is going to be slower over time, which means our inflation is going to be lower over time, which means interest rates are probably going to be not necessarily zero forever, but lower for an extended period of time, if not indefinitely. So lower inflation is going to lead to lower rates over time. So low inflation, short answer there.
Cool. All right, last question before we wrap things up for this Bear Market Brews. Adam, over to you. Any new financial opportunities for the new fall 2020 new college students?
Well, that's a great question. So that would be seniors graduating this year. And by the way, if that's your situation, there's this big trend on social media posting your senior picture. And I got to say, I'm not posting mine. I think Tony has seen it. We went to school together. We graduated in the same class, believe it or not.
I don't think you've changed a bit.
Really? Oh, man. Well, anyhow, I'm not going to post that on social media. Any new financial, I feel bad for this year's seniors. They're missing out. I remember our senior year. It was so many great things. And I really hope that there's an opportunity to finish school if you're here in Ohio, but we don't know yet. Any new opportunities for fall college students?
Well, one thing that comes to mind for me, Adam, is if this particular listener has maybe been saving for that new college graduate in a 529 plan, any allocations that may have been exposed to the stock market are likely down.
And great
so
point.
The fear or the inclination would be to sell. And this is not the time to sell and get defensive, or you don't want to see any more losses, because selling at the low is securing the loss. So as far as opportunities for fall of 2020, if you've participated in this webinar, you can tell that we are changing our tune to more bullish. I would think that the hope would be that those equity exposures might recover, and that 529 plan would be more readily available for you to have a higher balance to spend for that college tuition in the fall. That's one idea that comes to my mind.
That's a fantastic point, and nobody knows for sure, of course, but I think, hopefully there's other sources of funds, or, by now, if you have a senior, you surely have some bond funds allocated for that college cost. I would go there first. And like you said, I would let those stock funds rebound before. In the next 4 years, I would sure think that we would rebound from this.
Indeed. Wow, what a fast hour that was. Thank you so much for being a part of these webinars the past few weeks. We've enjoyed getting to know you and what you're drinking even better. We've put it on our to be bought list. It'll be great to try new brews over the next few weeks. We are not closing down the email address. So if you continue to have questions, feel free to pop a question to bmb@hzcapital.com. We will get through this together. On behalf of Adam, Austin, and myself, Tony Hixon, we are sending you virtual cheers. Thanks for being here. Remember, anyone you know can help, we would be able to assist. Please let them know that we are here to assist them. Thank you again, and we'll see you sometime soon. Take care.
Take care.
Cheers.